We are joined right now by Kevin Book of ClearView Energy Partners. He is a managing director. Previously, Kevin was a senior analyst at FBR. He is joining us now from Washington, D.C. Kevin, thanks for being with us. We just heard Dom update us there on the headlines, Libyan rebel forces advancing westward. About a week ago, you said oil was frothy. Now, do you still think this is the same with rebels moving in that direction?
Yeah, we still do, Deirdre, although there's some changes in our expectations that tend to reflect the sustained nature of the conflict. We're still about $10 above what we think a realistic price would be, and that $10 is about $10 less than we might have said before. And part of that is that if we are looking at a long-term engagement in Libya, 1 million barrels per day at least is likely to stay off the market for, as Secretary Clinton said yesterday, weeks to months.
So, Kevin, you brought up this great point. I mean, a sustained civil war is different than a rapid regime change. What is the difference? Just break it down for us in dollars per barrel, if you would.
Well, I think we're on a fundamental basis still closer to what should have been an $87 to $90 barrel for calendar 2011. But take 1 million barrels per day out of headroom from OPEC, and you're now in the 96 to 102 range based on our models. These models aren't perfect, and they don't necessarily reflect short-term fluctuations. But let's be fair about this. It's not just the civil war right now, but what happens afterwards that's of significant concern to supply. It may be that there's a lot of retribution and difficulty bringing a nation-building process into a country like Libya.
Kevin, what about the fact that Saudi Arabia, for one, has said, don't worry if Libyan oil production comes offline, we're actually going to make up the difference. Is that possible, and how has that factored into your calculations?
Well, it's eminently possible, Deirdre, but the problem is that it's not the same oil. They have certainly more than enough headroom. What they don't have is they don't have enough quality. Part of what you're seeing in the WTI Brent...
Is that what you mean, Kevin?
Exactly. So even as prices would start to fall in response to the Saudi ramping up of production, you'd still see a wide spread between WTI and Brent in all likelihood, particularly if our economy doesn't yet speed up to close the gap. We're seeing some serious opportunism and well deserved by refiners who are using their spreads and their opportunities to service the Western Europe market. But that's not enough necessarily to close that quality gap.
Kevin, is there any other product, energy product, that we should be monitoring? I mean, you gave us very precise levels for oil. What about natural gas? I mean, if there is a power shift, what else do we need to be watching?
Well, natural gas in the U.S. is fully decoupled from global events right now, probably to the detriment of a lot of U.S. producers who wish they could export into the anticipated LNG bid in response to global nuclear shutdowns. I think you should look first and foremost at distillate fuels, because that's what the world will use for backup power generation if nuclear power doesn't come back on. In the intermediate term, it is an LNG story. And frankly, if you go out 4 or 5 years, there's a real opportunity for rooftop and integrated solar, especially as Japan rebuilds.
Yep, green energy, never a bad idea, right, Kevin? Thanks very much. Kevin Book joining us there from ClearView Energy Partners.